So Danielle, like everybody wants to know, what do we have to look forward to?
Well, it depends on whether you're a buyer or a seller and whether or not you're looking forward to this year, right? So our 2019 forecast calls for a tougher road ahead for both buyers and sellers. That's not to say that it's going to be impossible, but there are factors that are going to make 2019 a little bit more difficult, regardless of what side of the housing market you're on. So to dig into buyers for the first perspective, buyers have some bright spots. We do expect more inventory in 2019 coming to market, so they will have more options to choose from. However, it's not going to be so much inventory that we see a lot of price pressure.
Right.
We see home prices slowing, so they will grow at about 2% pace instead of the 4 to 5% pace that we've seen in sales prices recently. So a slower pace of increase, but they're still increasing. So buyers are still looking at more expensive housing, coupled with the fact that mortgage rates are rising. So that's a trend we've had for the past couple years, and so we expect that to continue in 2019. Mortgage rates at the end of 2018 are going to finish the year right around 5%, and we expect them to finish next year around 5.5%. So they'll be about a half a percentage point higher. Those two factors combined, price increases and mortgage rate increases, mean that we're looking at about 8% more in the monthly payment. So then you combine that with income growth of around 2 to 3%, things are going to get a little bit more expensive for buyers, and that's why we say it's going to be tougher. It's not impossible, but if you've been looking for a while, it's not going to get easier on that front yet.
So they might start to feel a small squeeze, but not a lot. I mean, what I heard was about a 5% differential, right? Between it seemed that mortgage rates have been pretty steady, and I think the Fed just came out and said that they're actually going to hold mortgage rates. But you're saying you think we'll see a bit of an increase next year.
Yeah, so it's hard to interpret what the Fed says. Some people did read Chairman Powell's comments recently as we're going to wait and see, and he did emphasize that the Fed is being data dependent. So they're looking at the data and how data on the economy evolves and what that means for the rate path. They've been in this tightening cycle for the last couple years now, and we expect it to continue. Most forecasts had called for 3 to 4 increases in the Fed rate, the Fed funds rate next year, so 2019. We're expecting 2 to 3. In line with continued growth in the economy. But if for some reason economic growth shows signs of starting to slow, which it hasn't yet, but it could, if it does, then they might ratchet back on their expectations for the Fed funds rate increases that they're planning to do. And he said, we're closer to the neutral range on the federal funds rate. And earlier in the year, in October, I think it was, he had said something about, we still are a couple steps away from a neutral Fed funds rate level. So those two things are consistent. He hasn't really changed his position, but he has changed the focus of his position. That's caused some people to think, well, maybe they're going to move slower than they otherwise would have.
Let's talk about the Fed funds rate. What does that really mean? How does that play in? I think a lot of consumers don't really understand what that is.
Yeah, so the Fed funds rate is a short-term rate that they set for overnight borrowing between banks. And it has this cascading effect of, once the short-term rate is set at the rate that it's set, then that impacts long-term rates because you can create arbitrage opportunities to make money. Basically, you can loan the Fed money, banks can on a short-term basis, and then lend it out to others, and that basically cascades all the way up the yield curve. So mortgage rates are affected by those short-term rate trends and affected by the same factors that drive those short-term rate trends, so the overall strength of the economy, but they're not tied together in lockstep. So mortgage rates, most people take out a mortgage for 30 years.
Sure, or 15.
So right, 15 or 30 years, so long-term rates, and then they tend to stay in their homes for about 10 years. So we see mortgage rates tied very closely to the 10-year rate because that's sort of the time horizon. It's a similar time horizon. And the 10-year rate is affected by these short-term rates, but also by the general outlook on the overall economy, because people are thinking about not just what's going on now, but what's going to happen over the next 10 years. So that's why the Fed funds rate is sort of important to the mortgage rates, but so is the general economic outlook.
And I think in terms of the general economic outlook, obviously there's a lot of politics involved and sort of where we are politically. So how does a buyer navigate all of that? So they're on Realtor.com and they're looking. How do they navigate and decide what to do for 2019?
Well, they can do things like look at our forecast, so they don't have to try to piece together their own trends based on what they see in the market. We've done that for you, so by all means, look at our forecast. We expect mortgage rates to continue to increase based on the fact that we expect the economy to continue to improve in 2019. And so we'll go from about a 5% rate at the end of 2018 to roughly a 5.5% rate at the
bad.
end of 2019. So a half a percentage point increase. It's not terrible, but rates are going to get higher. So if you're thinking about this from the perspective of a buyer, you want to think about how you'll navigate this, right? So think about what you qualify for now in a home, and maybe test out what happens to your budget if mortgage rates do go to 5.5%, so that you don't have to totally revamp your search. You already know what your budget limit is at that higher mortgage rate.